Hi. Before I define what social impact analysis is, I want to quickly give a brief illustration of why it's important. Let's imagine we have this group of business ventures. They might be business ventures we're interested in investing in, or they might be ideas we've brainstormed and we're wondering which one to pursue. Being good business students, we're going to create these gorgeous, elaborate spreadsheets, and we're going to calculate the expected financial return of each and plot them. We find out a bunch of these business ventures, ideas or actual, are expected to have a negative financial return. We're going to let go of those. Some are positive. Then there's a whole heap of them that seem to have this kind of average market rate return, and a few real winners. We could stop there. Social impact analysis adds another dimension. So now I've got this y-axis. On the top, upper half of the y-axis is positive social impacts. And below is negative social impacts. We do more research, we do more analysis, and for the same set of business ventures, without changing the expected financial return, we plot them in terms of their expected social impact. And now the world looks different. Particularly this cluster of average market rate return enterprises, which before we were indifferent to, now are differentiated. I would imagine that any rational investor or entrepreneur for a given financial return would prefer to pursue one of the ventures with a high positive social impact, expected social impact, as opposed to one that's expected to do some social harm. There's some other things we can do with this table. So let's imagine that we were contemplating a social enterprise that ended up coming here, this circle here, with a negative financial return. So it will lose some money, but actually some hybrid businesses, that's fine, especially if you're making a positive social impact. But look, at that same level of positive social impact, we can make a positive financial return, even market rate financial return, and even, in this example, above market rate financial return. One of the things this analysis allows us to do is to think about financial return and social impact without presuming that certain kinds of vehicles, organizational vehicles, offer one and other kinds of vehicles offer another. In fact, we can plot charities here. All charities are 100% financial loss to the donor who gives away money, ignoring a tax donation, but they have different levels of social impact. In my hypothetical set of businesses, which are not representative of the total set of possible businesses, there is no relationship between positive social impact and positive financial returns. Some researchers have found that there is a positive relationship, such that a representative sample of businesses from our marketplace would align on this chart like this. Others have found the relationship more like a C, such that those organizations that have the highest financial return are bifurcated among the highest social impact organizations and the lowest social impact businesses. And this is looking at public companies. With social impact analysis, though, the point is not to say, pursue social impact because it will give you greater financial return. It's agnostic on that point. The point is simply to create visibility so that we can start to do some analysis and think thoughtfully about those trade-offs. Okay, so with that in mind, what is social impact analysis? Much of what today's presentation is going to be is defining it. We're going to define what is social, what is impact, how is impact different from outcomes, and to answer that question, we're going to have to look at a theory of change. We'll have a brief example from a real charity and also look at how theory of change is used in business. Then we'll answer the question, how do I start measuring my organization's social impact? And we'll focus on the process and how to choose the measures to measure. It's going to be brief. Finally, we'll very briefly look at how do you compare social impacts of different organizations. Social impact is the social change, both positive and negative, which arises from an organization's work. Pretty straightforward. In the background here, I have a beautiful forest, not simply because forests are pretty and it's in keeping with the eco-social theme, but because this definition only works when we see the forest for the trees. Within the specific context in which the term social impact is used, the definition shifts and changes. That's fine. We don't need to be dogmatic about a particular definition. We need a heads up so that we know to look carefully at what definitions other people are using, and so to make sure we define our own terms when we use the term social impact. So here we are in the trees, and we're going to look at the meaning of what is social. The example I gave before of the relationship between financial and social returns of publicly listed companies, there was one that found a positive relationship and one that found the C relationship. Those studies are based on ESG, or environmental social governance. And when they say social, they mean environmental social governance as one kind of idea. And specifically, they use data from a group called MSCI, which uses a proprietary set of indicators. The organization has labor practices such as this, or policies like this, whatever they have, their specific indicators that they apply to publicly listed companies with a score or a yes/no code for each organization. And then the researchers amalgamate those codes into a score and do their regression analysis or find the relationship. So that's ESG. Notice that the social is nested within social. So social is environmental social governance. The GRI, or the Global Reporting Initiative, breaks out that social component more. So when they use the word social, they're talking about labor practices, human rights, society, and product responsibility. Again, we've got this society tucked inside the meaning of social. In this context, it might be things like donations to charity groups or community outreach activities. The Integrated Reporting Council, which is a group that's endeavoring to replace existing financial accounting standards with a equally robust and rigorous standard that incorporates a broader set of ideas. They have a set of capitals, is what they call it. Intellectual capital, social capital, which is really relationship capital, human capital, and natural capital. So when they look at sort of social impact, they're talking about a collection of capitals. In all those cases, which tend to be oriented to the business world, social behaviors is sort of the internal practices of the organization. So the organization's own labor practices, their own gender diversity or hiring policies, equitable hiring policies. With charities, we tend to look outward. So when charities use the term social impact, they often mean, for example, the financial and well-being outcomes for beneficiaries. So that's on people, particularly if these are human service charities. This is from the Urban Institute, which is a great resource for understanding outcomes of charities. Or if the charity is not a human service organization, but say an environmental charity or like a zoo or a symphony, often social impact is performance toward mission. What they mean by social is performance toward mission. Different meanings of social. We just need to know what we're talking about when we talk about it. Impact. Impact is sometimes synonymous, as like a general term, synonymous with results or performance. So social impact just means like stuff that happened that affect social. But often when people use impact, they are using it in a very precise way to differentiate from outcomes. I'll get to outcomes in just a second. These are the different ways it can be differentiated from outcomes. For some, the difference between outcomes and impact is attribution. So outcomes are observed changes, but impacts are those that can be carefully, with research, attributed to the organization. That means the organization we're looking at, we can say caused those changes, as opposed to some coincidence or something else in the environment. Sometimes when people use impact, they're differentiating from outcomes, and the impacts are long-lasting change, whereas if outcomes might be more near-term, let's say 3 to 6 years, whereas if impacts are 7 to 10 years. Sometimes they're within the same time period, so not looking at different time periods, but they're broader knock-on effects of the charity's activities, intended and unintended. So we'll look at an example where a charity might be seeking to increase somebody's well-being, and that's their outcome, but this has societal impacts on things like hospital emergency room costs, police care costs, homeless shelter costs, etc. So it's got savings for the taxpayers, and that's what comes under impact. The GRI for example, uses the term impact to refer to any significant economic, environmental, and social impact. So we'll just look at the social, that are positive, negative, actual, potential, direct, indirect, short-term, long-term, intended, unintended. So that's a very broad definition, much more akin to the first one. Let's look at the theory of change so we can understand what outcomes are. A logic model is sometimes called a simplified theory of change. What I'm showing you is a logic model. I'm going to call it a theory of change. Quite simply, it is a strategy for converting resources you have to the change you want to see, to value, social value. It's analogous to a business's strategy, which is a way to convert resources that you have to greater financial value. And you'll see at the far end, there are outcomes and then impact. You will also notice that outputs, outcomes, impact are collectively, in this terminology, called results. So I'm going to go through what each of these things mean because it's the backbone of social impact analysis. I just want to give you a heads up that I'm getting these definitions and these illustrations from a document called Logic Model Development Guide from the Kellogg Foundation. It's a great document, really simple, for free online. And I'm going to be quoting from pages 1 and 10. Okay, resources. Resources are human, financial, organizational, and community resources a program has available to direct toward doing work. The only thing really of note here is that you will notice that a program has available to direct toward doing work, and the resources are organizational. Often when charities talk about social impact, they evaluate their impact at the level of the program. So many charities have many programs, and often they evaluate impact at the level of the program. Businesses, social purpose businesses, or for-profit businesses that just want to keep an eye on their social impact, tend to evaluate impact at the level of the organization. Same concept, just slightly different words. Activities. What the program does with its resources. These are processes, tools, events, technologies, actions, etc. that are intentional, part of the program implementation. So now we're getting into results. It can be tricky to disentangle outputs, outcomes, and impact, but let's give it a try. Outputs are the direct products of program activities. They often include types, levels of service, and services to be delivered by the program. I think the key thing with outputs is that they're really under the organization's control. An organization can choose to increase or decrease outputs. It's a matter of kind of management policy or resource allocation. Outcomes get a little harder to control. Outcomes are the specific changes in program participants' behavior, knowledge, skills, status, or level of functioning. This is written by Kellogg. They typically give grants to human service organizations, so we're looking at changes in an individual. But this could also be changes in the environment, could be changes in a system. It doesn't have to be program participants. And Kellogg Foundation makes a distinction between short-term at 1 to 3 years and long-term at 4 to 6 years. I think those are really reasonable and typical numbers, but I don't think there's a hard, fast rule that you would say short-term is 1 to 3 years and long-term is 4 to 6 years. An impact, according to Kellogg, is the fundamental intended or unintended change occurring in organizations, communities, or systems as a result of program activities. So when Kellogg uses the term impact, they are not only moving from a time frame, from outcomes which were short and long term to impacts which are even longer term, much stickier, but also they're moving to a systems level. They're moving from individuals to a system. Let's see if we can better understand this using an example. Our House is a Toronto charity that I've worked with. They're fabulous. They are a charitable social enterprise, which means they engage in the market. They are a social landlord. They buy buildings. They rent out apartments in those buildings for money to people, but they do so for a social purpose. In this case, they rent out apartments only to people who are, all three, coping with mental health, addiction, and poverty issues. One thing about this particular population is that they have challenges that make it very hard to stay housed. Or said conversely, they have habits that make it very likely to get evicted. And so, as you can imagine, it is very difficult for them to stay well if they are living on the street, but it's very difficult for them to stay housed. They're in a bit of a catch-22. What this organization does is rents apartments to people who qualify, and then provides them supports to help them stay housed so that they can then, with stable housing, get well. The vision is a world where everyone has stable housing, a sense of belonging, and a chance at a better life. Let's work through their theory of change. Resources. One of their resources might be government contracts. They get money from the government to do this work that they're doing. Other resources might be philanthropic donations, staff volunteers, partnerships with other service agencies, and their networks with other nonprofits. Activities. One of their main activities is purchasing and maintaining housing. They also provide tenant supports and facilitate community building activities among the tenants. Outputs. One of their outputs is the number of units they have available for rent. Really in the organization's control, right? They can mobilize their resources to acquire more units or not. It's a direct result of their purchasing and maintaining activity. It could also be number of tenants, number of community groups that they form, number of events they host. An outcome is trickier. One outcome for this organization, our house, might be number of tenants who've been stable in their housing for 3 or more years, or more than 3 years. It could also be number of tenants who report a greater sense of belonging, increased well-being, improved relationships, etc. And then in our house's framework, their impact is savings to healthcare services. One thing they have found is that when their target population stays housed, there are fewer police encounters, fewer visits to homeless shelters, and fewer unscheduled emergency visits, which is a real tax savings to the taxpayer. So that's the theory of change. I'm going to quickly show you these 2 examples of a theory of change created by other groups, but on our house. One, you can see what a completed theory of change might look like visually. But what I really want to highlight is that there's no strict rows across, right? So a key activity does not necessarily correspond with a single output, does not necessarily correspond with a single outcome or long-term outcome. Here's another organization. This is often called a outcome chain, but in this model, the way they've created it, same concept, is the pink boxes are activities, the yellow boxes are outcomes, and the purple box is the impact they're looking to see. The key thing is you've got relationships between what the organization is doing and what it's trying to achieve. And that is going to structure your analysis, not only of what you're going to do, but also what you're going to measure and how you're going to understand your social impact. I talked about the Integrated Reporting Council. This is their value creation model that they are advocating inspire corporations in their reporting of their broader concept of value. And you'll notice the circles right here in the middle: inputs, business activities, outputs, outcomes. The theory of change, or the logic model, is right in there. In this case, they have their 6 capitals we talked about: financial, manufactured, intellectual. Manufactured is like property, plants, and equipment, but also could be inventory assets, but not financial. Human, social, and relationship capital, and natural capital. So the organizations map their consumption of those capitals, the stocks and flows, understand their business processes, and then how their business processes affect the stocks and flows of those capitals. So the underlying concept of the theory of change applies both to charity and business. Social impact is the social change, both positive and negative, which arises from an organization's work. We covered that. Now you know the meaning of social varies depending on context. The meaning of impact varies depending on context. The impact is sometimes different from outcomes. And you know to pay attention when you see that word to find out how that particular report or speaker is using that term. And you also know that when using that term yourself, you should define what it is you mean. So let's move on to how you would do social impact measurement for your own organization. You're going to start by building your theory of change, set targets, track progress, report and communicate, and consult with stakeholders. The first time around, you start by consulting with stakeholders. If you were a business, one of the great reasons to consult with stakeholders, if you're a mission focused or a social purpose organization, the things that are important are can sometimes be defined. The social elements can sometimes be defined by your social purpose. If you don't have a social purpose, then you'll want to understand from stakeholders, ask stakeholders how your organization is or should be affecting their lives. And that will kind of help you put some things on the radar to be paying attention to. Stakeholders, if you're not familiar, are funders, staff, customers, members, etc. Then you build your theory of change. There's a great resource, again, for free, online, Creating Your Theory of Change. It's NPC's Practical Guide. You can get it here. I'll leave it at that for now. You then want to select indicators and targets. And for this piece, I'm going to be drawing terms and words from a document from the Urban Institute, Transforming Performance Measurement for the 21st Century. They have a great point. First, consider indicators for which you already have data. When I spent years as a charity analyst, I was surprised by the number of times charities had an immense amount of data that they were gathering just to get their work done, just to organize and manage their day-to-day activities. There were spreadsheets, there were emails, there were lists, there was stuff happening just to get the work done. And very few of them had mined that list to give them insights into how their social performance was. So an example, we've got this photo that I took off the internet. Apparently it's a FEMA home repair photo, but it stands in for our house has a maintenance department, and that maintenance department had all sorts of information about work orders. Work orders come in, how many come in, who they were assigned to, when they were fulfilled, etc. And our house realized that they could use number of work orders and the time to complete them as a measure of their performance of how well they were doing at maintenance. So that's an example of look at the data you already have when you're building your indicators and targets. But then there's this next piece, which is really important. You've got to consider indicators that you need to measure for which you don't already have data, and you need to go and get that data. One of the most central ideas in our house's mission was the improved well-being of their tenants. Well, there's a Canadian Index of Well-being. It's you can get it at universityofwaterloo.ca, and it's a survey that you can administer and track, gauge well-being and changes in well-being over time with a certain population. So they could get that data and start gathering the data they need to be accountable to themselves and track impact around well-being. So here are some ideas that have been thrown out there for why it's useful for organizations to pay attention to their own social impact. Those organizations, it has been said, have greater environmental awareness. And this isn't like eco-awareness. This is more like by being in touch with stakeholders and awareness of the organization's impact in their community, those businesses also tend to be more aware of new ideas, emerging trends, competitor movements, etc. They tend to have a greater context or business environment awareness. They may have a sense of a larger purpose. It has been said that those organizations that have higher social impact performers are also less risky. They have less volatility. It's been said they have higher financial performance, although I think the research is still out on that one. You are more accountable, which is a good thing. And overall, it's been said that better managing the social elements of a business makes better management overall. So whether or not you publish this to the outside world beyond your immediate stakeholders, there are advantages. But we started with this idea that one of the main benefits of social impact is so that we can see the range of businesses in a much more rich space and make more thoughtful decisions about which ones we want to start or which ones we want to invest in or which ones we want to shop from, etc. So I'm very briefly going to talk about how you compare social impact. One thing we can do is select our indicators and targets to improve comparability. At a minimum, your organization should be consistent within your organization. There is no excuse unless you've completely revised your strategy to change the indicators that you're using to measure performance from year to year. There should be the same measures, the same indicators from year to year. The number will of course change, but the way you're framing the measure should stay the same from year to year. If you're a broad organization, it's got to be the same from chapter to chapter or location to location. If that's not possible, go for a core group of common indicators, and then allow different groups to add on maybe, say you've got a core group of 10, 12 indicators that speak to maybe 3 key ideas, then maybe there could be another 3 or 4 indicators that each group adds on. The other thing you can do is strive for comparable indicators. So a bunch of groups have created what I would call indicator banks. IRIS, the Urban Institute's Outcome Indicator Project, and the Global Reporting Initiative. They have specific indicators well defined, and these are indicators that appear often, or they appear often in very similar forms. And sometimes organizations have a slightly different indicator, not justified in any fundamental difference in context or activity or mission, but just because they didn't check in and go with the more standard approach. So you can use these, you can check out IRIS, you can check out the Urban Institute's Outcome Indicator Project, and you can check out GRI. GRI tends to be more for, better suited for, they're for everybody, definitely, but all sizes, sectors, etc., locations, but tend to be better suited for for-profit enterprises. Whereas if the Urban Institute tends to be really well suited to like human service organizations or education or like, the businesses that typically come to mind when you think charity. And IRIS is designed around impact investing, so it kind of straddles both worlds. And you can check those out and try and borrow your indicators from there, and then you've got indicators that are quite comparable with other organizations that are using them. When comparing organizations, carefully, that's all I can say. We've already discussed how the definitions of social impact change. It doesn't take much imagination that with different underlying notions of social impact, the reported measures are going to be very different. Scope and domain are 2 words that refer to the areas that an organization chooses to pay attention to. So it could be like labor practices or well-being, financial health of beneficiaries, etc. Maybe their debt levels. So different organizations might measure different scopes in different domains. They set different boundaries for the impact measurement they've embarked on. And with different boundaries, you're going to get different numbers for the same exact impact. And timeframes can be different. Actually, organizations that have a longer time frame tend to show less impact, where impact I'm now using as a broad kind of all types of results. A longer time frame tend to have less impact because it's so hard to make social change, positive social change, sticky. If you do want to compare, one of the strategies is to represent outcomes or impacts in dollar terms using financial proxies. And this has to be done quite carefully, but it can be done very well. And the SROI network in Canada has some really good tips and tools for how to do that. So that's using finding ways to value impacts, express them in dollar terms, and that allows many different impacts across well-being and environment and health and governance to be added up and expressed as a single number, which allows you to get that mapping. So that's your whirlwind introduction to social impact analysis. I hope it was helpful, and I hope you're enjoying your conference, and best of luck as you embark on your ventures.